restrictions, such as limiting ownership in the fund by the sponsoring banking entity and prohibiting a banking entity from acquiring low-quality assets from the fund to help ensure that such vehicles cannot be used to help banking entities evade the requirements of the Volcker Rule. The proposal also would revise the current rule to allow banking entities to invest in and sponsor credit funds and venture capital funds, which do not present the risks that the Volcker Rule was intended to address. Both loan securitizations and credit funds help facilitate the extension of credit to consumers and businesses and do not resemble the private equity funds and hedge funds Congress intended the agencies to treat as covered funds. The Volcker Rule by statute excludes vehicles established to facilitate the sale and securitization of loans from the definition of covered funds. In some instances, however, the Volcker Rule has made it difficult for banking entities to invest in or sponsor substantially similar funds that make loans, invest in debt securities, or otherwise extend credit. Therefore, the proposal would allow banking entities to sponsor and invest in credit funds subject to specific eligibility criteria. Venture capital funds also may be subject to the current Volcker Rule covered fund restrictions. Venture capital funds are an important source of financing for small businesses and startup firms. Banking entities have authority to make direct equity investments in small businesses, but the Volcker Rule imposes strict limits on their ability to invest in diversified pools of venture equity. The legislative history of the Dodd-Frank Act suggests that a number of members of Congress supported the agencies permitting venture fund investments under the Volcker Rule. The inclusion in the statute of an exclusion for small business investment companies further reinforces the desire of Congress to prevent the Volcker Rule from impeding bank involvement with venture capital funds. Accordingly, the proposal would allow banking entities to sponsor and invest in venture capital funds subject to specific eligibility criteria. The proposal includes certain restrictions to help ensure that these provisions are not used to evade the textual requirements or the spirit of the Volcker Rule. Under the proposal, both credit funds and venture capital funds would be expressly prohibited from engaging in proprietary trading. In addition, a banking entity that invests in or sponsors such funds would be prohibited from guaranteeing the fund's performance and would be required to disclose this prohibition to the fund's investors. Although a banking entity would be permitted to hold ownership interests in these funds, a banking entity would otherwise be limited in the relationships it could have with such funds. Finally, the proposal would permit a banking entity to engage in limited, low-risk transactions with related covered funds. The current regulations prohibit a banking entity that serves as an investment advisor or sponsor to a covered fund from entering into certain transactions with the fund. Specifically, the rule prohibits transactions between a banking entity and a sponsored or advised fund that would be subject to Section 23A of the Federal Reserve Act. The proposal would permit a banking entity to enter into certain transactions with a related covered fund. The permitted transactions would include those that an insured depository institution may enter into with an affiliate without limit under Section 23A, including, for example, intraday extensions of credit. In addition, the proposal would allow a banking entity to extend short-term credit to a related covered fund in connection with providing payment, clearing, and settlement services to the fund. This concludes staff's prepared remarks. My colleagues and I would be pleased to answer your questions.
Thank you very much for your presentations. I have a couple of questions. So the rule has been in effect for something like 6 years, I guess, and markets have adapted, regulated institutions have adapted. So why is today's proposal necessary?
So I can answer your question. Since the adoption of the covered fund provisions in 2013, the agencies have received a number of comments regarding the extraterritorial impact of these provisions, the restrictions that limit traditional bank services to covered funds, and other concerns regarding the scope of the prohibition. In addition, staff's experience, both in implementing the 2013 rule and in supervising firms for Volcker compliance, has suggested the need for certain simplifications, clarifications, and refinements of the rule. Commenters on the 2018 proposal also specifically expressed concern about how the current rule interrupts traditional banking and asset management activities, which don't raise the risks intended to be addressed by the Volcker Rule. Today's proposal would address some of the concerns with the covered fund provisions, including the extraterritorial application of the rule. It would also give banks slightly more flexibility to offer traditional banking and asset management services, such as payment, clearing, and settlement services provided to affiliated funds. Finally, it would permit banking entities more flexibility. Finally, it would permit banking entities to offer and invest in certain funds that don't pose the same types of risks that the Volcker Rule was intended to address.
Thank you. I have another question, which is, I would agree that the proposed relief to foreign funds is warranted, but the question I would ask you is, how comfortable are you that you've calibrated that relief at a level that will leave the foreign banks on a level playing field, but not having an advantage over U.S. firms?
I'd be happy to answer that question as well. So we're comfortable with the provided relief for several reasons. The proposal provides relief to a limited class of foreign funds organized by foreign banks and offered outside of the United States to foreign investors. In addition, the relief provided is identical in scope to the policy statements that have been previously issued by the federal banking agencies that address this issue. This exclusion in general would mitigate some of the extraterritorial impact of the Volcker Rule while limiting opportunities for banking entities to evade the requirements of the rule. It's also clear that the statute differentiates between U.S. firms and foreign firms in certain key respects. For example, the statute provides foreign firms with greater latitude to engage in covered fund investment and sponsorship activities, as well as proprietary trading activities outside of the United States. So we're comfortable. We think our proposal here is consistent with congressional intent. Finally, I would note that foreign banks would continue to be subject to the same limitations as U.S. funds with respect to asset management activities conducted in the United States.
I would just add one additional point. As a general matter, when we craft our regulations, we try to minimize the extraterritoriality of those regulations on foreign firms, if we have statutory authority to do that, and we do here. And that's part of a more complicated kind of multi-step process where we also have that same expectation for foreign countries. We expect them to minimize the extraterritoriality of their rules on our firms. So for us, again, from a reciprocity consideration, providing this sort of extraterritoriality relief to foreign funds is, I think, part of a longer-term kind of agreement among nations to try to minimize the burden on foreign firms of their domestic rules.
Great, thank you very much. I'm now going to ask my colleagues if they have any questions they'd like to ask on this topic, beginning with Vice Chair Clarida.
Thank you, Chair Powell. I have no questions. As usual, I received a thorough and comprehensive briefing from staff, and that answered my questions.
Thank you. Vice Chair Quarles.
Well, I think I know the answer to this, but let me ask it.
You're sharing.
But I think it's an important question, so let me ask it anyway. So, but one of the major purposes of the covered funds provisions is to, if not the major purpose, is to prevent banks from creating structures to do indirectly what the Volcker Rule would not permit them to do directly. So the proposals that we're making today don't themselves have any particular cap on how much a bank could own of a covered fund. So what makes us comfortable that this couldn't be an evasion mechanism? The bank could own sort of a very large percentage of one of these covered funds and therefore effectively be the entity that was conducting one of these activities. Couldn't do directly.
So I'd be pleased to answer that question as well. So the proposal includes several eligibility criteria and restrictions that limit the scope of the proposed fund activities and are intended to address the evasion risks. All the proposed permitted fund provisions would also prohibit a banking entity from guaranteeing the performance of the fund. So this prohibition would address the statutory concern that banking entities could have incentives to bail out funds that they organize and offer. And in addition, the existing capital regulations impose high capital requirements on any investments in risky funds.
Thank you.
Thank you. Any questions, Governor Brainerd?
No, I've also appreciated all the information I received from staff. Thank you.
Governor Bowman?
Yes, thank you, Mr. Chair. So the question I have relates to smaller regional and community banks. So focusing more on the regional banks. So how does the Volcker proposal treat the non-complex and smaller banks that are not excluded from the rule, as community banks are now excluded from the rule? For example, those that fall within the $10 to $50 billion range, or even up to $100 billion.
Thank you for your question, Governor Bowman. The changes in the proposal do generally apply to all financial institutions subject to the rule. However, there are many non-complex and smaller institutions that engage in fund activities that could be directly impacted by the proposal. And I'd like to give sort of three examples, I think, that are salient. One, the proposal may give smaller institutions flexibility to provide services to their customers, for example, families in the communities they serve. Currently, smaller banks may give asset management services or other sort of estate planning services to families, and they can do this directly, or they can do it through a trust structure. The proposal would permit banking entities, smaller and non-complex banking entities, to provide these services through an investment vehicle set up just for that family. So I think that's a helpful tool that would be available to smaller and non-complex institutions. There's also perhaps greater flexibility for smaller banking institutions in making investments. So I'd point out two particular provisions that may be useful. One change, while it seems minor on its face, could be helpful, and that's the clarification with respect to small business investment companies. Currently, small business investment companies investments are permitted by the statute, but only so long as they have a license. Typically, and quite often, a small business investment company during the wind-down phase will relinquish that license and therefore call into question whether the investment in the SBIC is permissible. This rule would clarify that, no, it remains permissible throughout that life cycle of the SBIC, the small business investment company. Another example, I think Flora addressed this a little bit, was permitting venture capital fund investments. The proposal would give smaller banks and non-complex banks sort of greater flexibility to support businesses in their local communities. And again, these banks may not have the balance sheet that would justify making the same number and degree of sort of diversified investments, but now through a fund structure, maybe that facilitates a more diversified investment in the same venture capital fund investments.
Thank you. I appreciate you answering my question and for the very in-depth briefings that you provided prior to the meeting today. Thank you.
Thank you. And now back to Mark Vanderweide to introduce the second discussion item.
Thank you, Chair Powell. This final control rule that we're going to discuss in the second part of the program has been decades in the making. Banking firms and investors in banking firms have spent a lot of time over the past few decades importuning board staff for a control opinion about a proposed investment in a banking firm or by a banking firm. While staff often has been able to give a clear and quick answer, the prosecution of other control questions has resembled more the attempts of Kafka's protagonist K to get answers from the government authorities in the castle. I think this final rule will be a great leap forward in transforming a set of Gnostic rules of thumb that had been developed through a mostly hermetic common law process by a set of board staff priests and acolytes, myself among them, into a set of comprehensive, uniform, consistent public rules available to all. I will now turn it over to Greg Frischman and Mark Burish to provide an overview of the final rule.
Thank you, Mark. The final rule establishes a new control framework that would provide greater clarity and transparency by updating the board's regulations related to control under the Bank Holding Company Act and the Homeowners Loan Act. Control is a foundational concept under both the Bank Holding Company Act and the Homeowners Loan Act. Control determines whether or not entities are regulated by the board as bank holding companies and savings and loan holding companies, or as subsidiaries of bank holding companies and savings and loan holding companies. Under the statutory framework, control exists if certain bright line standards are satisfied, or if the board determines there to be controlling influence based on all the facts and circumstances presented. Over many years, the board has had considerable experience applying this standard on a case-by-case basis. The final rule would significantly improve transparency around the board's views on what generally constitutes a controlling influence by providing a clear set of standards to the public. The final rule is generally similar to the proposal, with a few adjustments that we will describe. Under the Bank Holding Company Act, a bank holding company is defined as a company that controls a bank. Under the Homeowners Loan Act, a savings and loan holding company is defined as a company that controls a savings association. The Bank Holding Company Act provides 3 tests for control. First, a company controls another company if it controls 25% or more of any class of voting securities of the other company. Second, a company controls another company if it controls the election of a majority of the directors of the other company. The third test for control is more complex because it involves a fact-based determination by the board. Under this third test, a company controls another company if the board determines that it exercises a controlling influence over the management or policies of the other company. The definition of control in the Homeowners Loan Act is substantially similar. Over time, review of controlling influence fact patterns on a case-by-case basis has led the board and staff to develop internal general standards for common controlling influence questions. The case-by-case reviews frequently involve assessment of confidential business information, and the staff's conclusions often are not issued publicly. Establishing a comprehensive public framework to describe the common features of investments that generally raise control concerns should make it less difficult for the public to evaluate questions of control. Banking organizations have stated that the lack of transparency around the board's control framework causes difficulty for banks seeking to raise and deploy capital. The downsides of this lack of transparency have been felt most acutely by community banks, which are more likely to rely on a capital base with a few significant investors. I will now turn to my colleague Mark Burish, who will describe the final rule in more detail.
Thank you, Greg. The final rule is generally consistent with the proposal, though several changes have been made after consideration of public comment. The proposal's signature element was a new, clear and transparent tiered framework for control that was designed to reflect the major factors and thresholds that the board has viewed as indicators of control. The proposal also provided clarifications to important control-related concepts and definitions. The proposed tiered framework focused on 2 critical dimensions of control. First, the amount of voting securities controlled by the investor, and second, other specific relationships between the investor and the target company. The proposal provided a matrix in which different combinations of voting securities and other relationships would trigger presumptions of control. As a general matter, an investor with a larger percentage of voting securities in another company would have been required to have smaller relationships in other areas to avoid control over the other company. Beyond voting securities, the proposal focused on the following other relationships: non-voting equity investments, rights to director representation, management, employee, or director interlocks, agreements that allow a company to influence or restrict management decisions, and business relationships. The board has often considered these types of relationships when evaluating control concerns. In addition to setting forth the core tiered framework, the proposal provided certain new definitions, standards, and other presumptions. For example, the proposal clarified that a company with less than 10% of the voting securities of another company generally would be presumed to not control the second company. The proposal also clarified that the board's heightened expectations in situations where a company seeks to terminate an existing control relationship. Other elements included clarifications on how to calculate one company's total equity investment in another, how to distinguish voting securities from non-voting securities, and what types of contractual rights may raise control concerns. The final rule is largely consistent with the proposal, though staff is recommending certain changes in response to public comment. As with the proposal, the core of the final rule is a series of tiered presumptions of control based on a company's level of voting securities in another company and other relationships with the other company. The memorandum to the board for today's meeting includes a table showing how the control standards would apply across different ranges of voting equity. The final rule's tiered framework differs from the proposal in 2 ways that I want to highlight. First, the final business relationship standards only take into account the perspective of the target company, not the perspective of the investor. This change simplifies the framework and recognizes that business relationships that are significant from the perspective of the target company provide the investor with a more direct and powerful lever to exercise control than business relationships that are only significant from the perspective of the investor. Second, the final rule simplifies the total equity standards for bank holding companies. Under the proposal, a non-controlling investor could have up to 1/3 of the total equity of the target company if the investor's voting interest was less than 15%. A non-controlling investor with a voting interest of 15% or more was limited to a total equity interest of less than 25%. The final rule removes the 15% voting standard and applies a total equity cap of 1/3 to all non-controlling investors. Staff believes that this change is appropriate to simplify the framework and to reflect the lesser relative control power of non-voting equity compared to voting equity. Outside of the core-tiered framework, I'd like to flag 4 items. First, the final rule includes a heightened standard for terminating an existing control relationship without change from the proposal, though certain public comments recommended removing the standard. The legislative history and relevant case law strongly support retention of a heightened standard for terminating an existing control relationship. Under the final rule, as under the proposal, a controlling company may break control either by divesting to a voting interest of less than 15% or divesting to a voting interest of less than 25% and waiting 2 years. Second, the final rule includes a standard for control where one company consolidates another company on its financial statements under U.S. generally accepted accounting principles. Certain commenters urge the board to eliminate this part of the proposal, but staff recommends retaining it without change. Staff believes that incorporating accounting standards will increase transparency, reduce compliance burden, and increase harmony between the accounting and bank regulatory frameworks. Third, the final rule includes a slightly revised standard for control over investment funds. Specifically, the final rule does not include the proposal's special standard for SEC-registered investment companies. Staff believes that the general investment fund standard in the final rule provides an appropriate treatment for SEC-registered funds, and that removal of the special standard for SEC-registered funds will clarify and simplify the framework without materially altering the stringency of the rule. Fourth, the final rule includes a standard for non-control without change from the proposal. Under the standard, a company that owns less than 10% of the voting securities of another company generally would not have control. Finally, I note that the final rule adopts various control-related definitions and calculation methodologies as well, with a few adjustments relative to the proposal in response to public comment. The most significant of these changes involve modest tweaks to the total equity calculation methodology. Staff believes that these changes are appropriate to simplify and clarify the framework without resulting in materially different outcomes relative to the proposal. Thank you, and we'd be happy to address any questions you may have about the final rule.
Thanks again for your presentations, and we have an opportunity for questions, beginning with Vice Chair Clarity.
I have no questions, Chair Powell.
Vice Chair for Supervision, Quarles.
One question, again, I think an important question to discuss. So historically, given that there wasn't a regulation or a really public framework around this, the board's control precedents were essentially enforced by investors signing on to a series of commitments. I mean, over time, those have become routinized, but occasionally there were kinks or Phillips in them. Will those passivity now in this new framework and with the public regulation? Will we continue to seek those passivity commitments from investors?
I can answer that. Staff believes that passivity commitments will generally no longer be necessary to address controlling influence concerns, at least in the ordinary course. Instead, investors in most cases will be able to rely on the tiered framework in the final rule to determine whether or not they may be considered to have control over another company. Thank you.
Thank you. Governor Brand? Governor Bowman?
Yes, Mr. Chair, I have a question about how this rule applies to our smaller and community banks, and specifically, how does it assist them with business planning and decision-making and potential acquisition planning, those kinds of things for the community and smaller banks?
I'll take that and I'll try that. Is it the transparency of the final rule should facilitate in the development of instruments and overall capital raises for smaller organizations, which are often closely held, and they can't go to the public markets to raise capital. They are privately negotiated transactions for the most part, and these rules should facilitate that process.
Thank you.
Thank you, and thanks again. I'm now going to turn to my colleagues for their positions on these two matters, beginning with Vice Chair Clarida.
Thank you, Chair Powell. I support the final control rule before the board Today, the final rule will provide significant clarity to the public by distilling the board's standards into a transparent and comprehensive framework laid out clearly in regulation. I think this is a big step forward. This important increase in transparency will help all parties better understand the board's views on these concepts. And Chair Powell, I also support a notice of proposed rulemaking on Section 13 of the Bank Holding Company Act, the Volcker Rule. I support issuing this notice and very much look forward to, as I always do, and will study carefully the comments received on this important matter. Thank you.
Thank you. Vice Chair for Supervision Quarles.
Thank you, Chair. I support both measures before us, the proposal on covered funds under the Volcker Rule and the final rule on control. Like Vice Chair Clarida, I'll be looking forward to the comments that we receive on the Volcker Rule proposal, but I do think the proposal is a very good framework for ensuring that we comply with the law, but allow activities that are in compliance with the law subject to appropriate safeguards. So I'll support both measures.
Thank you. Governor Brainerd.
Thank you, Mr. Chair. The purpose of the Volcker Rule is to limit banks' exposure to speculative trading activity and risky funds so they don't, again, put taxpayer funds at risk. I have previously supported exempting community banks from the Volcker Rule, and I do support today's proposal to address the inadvertent treatment of foreign funds as banking entities. However, I do have concerns that several of the proposed changes will weaken core protections in the Volcker Rule and enable banking firms to engage in high-risk activities related to covered funds once again. The proposal opens the door for firms to invest without limit in venture capital funds and credit funds. The proposal suggests these funds don't raise concerns about banks' involvement in risky activity that the Volcker Rule was intended to address. To the contrary, it is clear why Congress legislated the Volcker Rule to limit these types of activities. Some credit funds played a material role in the financial crisis. These funds weren't transparent in their activities, misled investors, and contributed to the financial abuses Congress intended to address. Venture capital funds are a type of private equity fund. As such, they pose similar risks. The agencies determined in 2013 that excluding venture capital funds from the definition of covered funds is not supported by the statutory language. I do not see the basis for excluding venture capital funds. The proposal also asks whether to carve out from the Volcker Rule's restriction on private equity funds those private equity funds that pursue a long-term investment strategy. Such an exclusion appears to be inconsistent with the statute. No change in the statute or in the nature of the activities would call for weakening the protections Congress put in place. With regard to congressional intent, it is notable that Congress did amend the Volcker Rule 2 years ago and chose not to make any of today's proposed changes. In particular, Congress chose not to add an exclusion for venture capital funds or credit funds. Finally, pursuant to the 2013 rule, the regulators were clear that a banking entity couldn't evade the Volcker Rule's fund investment limits by creating a synthetic interest in a sponsored covered fund. This was intended to address the risk that a bank making side investments alongside a sponsored fund and telling fund investors about the side investment would have strong incentives to bail out the fund if it got into trouble. Not only would today's proposal give banking firms the green light to exclude parallel investments from the statutory limits, but it would also explicitly allow them to market the covered fund on the basis of the parallel investments. For these reasons, I do not support the Volcker covered funds proposal. With regard to control, the final rule substantially increases the transparency and clarity of the board's control framework, and I do support it. Establishing a comprehensive, transparent framework for control should facilitate the consistent application of control standards under the Bank Holding Company Act and the Homeowners Loan Act, and better enable the public to evaluate issues of control when they arise. I appreciate all the work that went into these proposals, and I look forward to public comments. Thank you, Mr. Chair.
Thank you. Governor Bowman.
Thank you, Mr. Chair. First, I'd like to discuss the Volcker Rule proposal. Both the Volcker Rules statute and regulations have changed in several ways over the last few years. Community banks are now exempt from the rule. In 2019, the agencies amended the rule to tailor compliance requirements based on the size and trading activity. These changes have helped focus the rule on the activities of the largest banks that do the most trading. But even with these changes, the rule has had some impact on smaller, non-complex banks, including banks that are not engaged in trading activity. I'm hopeful that today's proposal will address some of these impacts on smaller banks, and that smaller banks will provide feedback on the proposal during the comment period. I believe that the changes we're proposing today will stay true to the intent of the statute while reducing burden and making it easier for banks to serve their clients. I support this proposal, and I look forward to reviewing the comments during the comment process. Turning to the final control rule, I believe this rule creates and provides greater transparency, clarity, and certainty to a critical aspect of our supervisory and regulatory work. The rule affects a broad range of entities, including community banks. Many banks, especially community banks, have spent a great deal of time, money, and effort trying to determine whether a particular ownership structure or capital investment could raise concerns under the board's control standards. By providing a clear roadmap, this rule should make it less complicated for all institutions, particularly for smaller banks, to raise capital and make strategic investments with an advanced understanding of the legal implications of those activities. For these reasons, I support this rule. Thank you.
Thank you. Thanks, everyone, for your comments and views. I will support both the Volcker Rule proposal and the control final rule. As I indicated in my opening remarks, I support the intent behind the Volcker Rule, and it is the law. But a simpler and clearer approach is needed for both banks and regulators. This proposal does that and makes also additional changes that I'm supportive of. I'll be looking forward to the comments we receive and evaluating them. Second, I'm also supportive of the control final rule. It will bring much needed transparency and clarity to that process and will be helpful for everyone. So we will now proceed to an actual vote, and we'll begin with the notice of proposed rulemaking on Section 13 of the Bank Holding Company Act. I need a motion to approve a notice of proposed rulemaking for revisions to the regulation implementing Section 13 of the Bank Holding Company Act, commonly known as the Volcker Rule. We'll do serial motions and then one vote. So I need a motion there.
So moved.
I need a second.
Second.
I also need a motion to authorize staff to make conforming non-substantive changes, such as those requested by the OCC, FDIC, SEC, and CFTC in connection with each agency's approval of a substantially similar notice of proposed rulemaking.
So moved.
Second.
And I need a motion to authorize the staff to make minor and technical changes to prepare the related Federal Register documents for publication.
So moved.
Second.
And I will now ask each of you individually for your votes.
I vote yes on both proposals.
I vote yes.
No.
Yes.
Okay, second, we'll vote on the final rule to revise the board's control framework. A final rule to revise the regulations related to determining whether one company controls another company, and staff to make any minor or non-substantive changes. So I need a motion to approve.
So moved.
And a second. There we go. And I'll now ask each board member individually for your vote.
I vote yes.
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 And yes. So both motions have carried. Thank you very much, everyone. That concludes our meeting. And thanks again to staff for all your great work. Very much appreciated. Thanks again.